Well, as we know, investors are awaiting Fed Chair Jerome Powell's comments tomorrow. They'll be listening for clues on how far and fast the Fed will continue to hike rates. What Powell says has the potential to move markets. But rather than get caught up in the reaction, where can investors look for some stability, no matter where rates go from here? Robert Moffat joins us now. He's director and portfolio manager at Middlefield Capital Corporation. Thanks so much for joining us, Robert.
Thanks for having me.
So markets have been really Fed-driven, and it's interesting. We were just talking to Dennis Lockhart, a former Federal Reserve Bank of Atlanta president, and he was talking about how the September meeting could really come down to the wire, even for the Fed, in terms of its decision. So it sounds like the opportunity for volatility is there potentially. What are your thoughts on just how volatile things could be? In the next few weeks or months?
Yeah, I would tend to agree that markets could continue to be volatile for the next few months. The Fed meeting is one of the events that everybody's watching, but really what's been driving it has been mixed economic data. So on the one hand, we've had, I think Q2 earnings held in a lot better than people had expected. We've probably seen the worst that we have in inflation. Inflation has probably peaked. And consumer spending statistics have actually held in quite well. So there are reasons to be optimistic. However, on the other hand, inflation is still in the mid to high single digits, and it's not clear when we're going to get back to our normal rate around 2 to 3%. There's still a number of issues. The war in the Ukraine and Russia is still ongoing with no real end in sight, and tensions are escalating in Taiwan as well. So with all this mixed economic data, there's quite a vigorous debate between bulls and bears going on right now, and that's driven the market volatility, and I do expect that to persist, and especially as we come into September, which is historically a more volatile month.
So how often should investors be sort of rethinking things during volatile times like these?
So I think investors should always be, on top of their investments and being tactical with their asset allocation. One sector that I believe is a great tool to use to mitigate the impacts of volatility is the healthcare sector. Mm-hmm. Healthcare has historically exhibited lower volatility of returns at least over the last 10 years. And that can really help stabilize a portfolio with an investment. And it's a very important sector that Canadians are generally underweight. So it represents almost 14% of the S&P 500 right now. That's the second biggest sector weight in the entire index. And it's less than 50 basis points of the TSX. So Canadians are typically underweight this sector. It's a great sector to invest in. It has defensive attributes that I think Canadians are usually underexposed to. So I would recommend considering an investment there. Interesting
in how, that exposure part of it for sure. Okay, so in terms of healthcare, in this particular environment, what would you be looking for within the healthcare sector?
So I would encourage, and you asked the question before about how often we should, be considering volatility. I think that right now it makes a lot of sense to be sort of tactical with your asset allocation and be employ a tactical strategy. And what I mean by that is that when the market has been on, a good run and performed well, like we've seen over the last couple of months, I think it's prudent to tilt your portfolio a little bit more defensively and start to, maybe add some of those defensive healthcare stocks. And then if the market does pull back, and I do think that's a possibility over the next few months, it makes sense to maybe add a little bit of risk back into your portfolios and start buying some of the more growthy names that trade at higher valuations. So I do think it's prudent to be tactical with your asset allocation. Right now, I think we're probably towards the upper end of the market's trading range, being at about 4,200 on the S&P 500 today after the close. So, towards the upper end of the range, and I think it is the right time to maybe position a little bit more defensively. Specifically within healthcare, I think that pharmaceuticals are probably the first place you'd want to look just for the stability that those stocks provide.
Is biopharma. Okay, so we're looking at a couple of different companies here, Merck, AstraZeneca, and AbbVie. Can you tell us a bit about, the characteristics that you'd be looking for in these types of companies?
Sure. So pharmaceuticals are biopharma stocks. They have extremely attractive and defensive fundamentals. So they have profit margins over 20%, which it compares to the S&P average of about 12%. So they're very highly profitable. They typically have low leverage. All three of these companies have, very clean balance sheets with the capacity to expand them. And so those are some of the, profitability, and they all trade at reasonable valuations as well. So those are some of the metrics that we would look at. Merck is a core holding across our healthcare funds. The stock trades at only 12 times forward earnings, pays a dividend yield of about 3%. Merck is one of the leaders in oncology. It sells the world's leading cancer drug called Keytruda, which is really core and stable part of its business. And its oncology platforms is complemented by an animal health business and a vaccines business, which are also very stable. So Merck is a very reliable company that you can kind of put away, clip a dividend. It's going to exhibit lower volatility than the average stock in the market.
And what about? Oh, sorry, didn't mean to cut you off there, Robert.
Go ahead.
Well, I was just thinking, maybe what about if markets were to turn lower, what sort of stocks would you be looking at that point in this space? Would that be more the med tech and biotech side of things?
Yeah, exactly. So med tech and medical equipment companies, they have really been, impacted by the sell-off we've seen in growth stocks this year. A lot of stocks are trading at, 20, 30, 40% even below where they started the year at. A couple names that I really like in the med tech space are Edwards Life Sciences and Intuitive Surgical. Both of these companies, they make medical equipment and devices that are at the cutting edge of innovation. These companies don't pay dividends. They typically reinvest their profits back into R&D and into developing new products. Again, they're trading at very steep discounts to their all-time highs. And I do think that, if we do see a bit of a pullback in the market, these stocks are ones that you want to consider adding to because they will probably outperform in a market rebound.
Okay. Robert, great to have you walk us through the healthcare sector. We really appreciate it.
Thank you.